And they can hear us. All right, everyone, let's just give it a minute or two and then we'll get started. All right, looks like we have a good amount of attendees, so we'll go ahead and get started. Before I hand it over to our presenters today, just have a few housekeeping announcements for you guys. All of our phone lines have been muted, so if you do have any questions, please feel free to use the Q&A box located on your menu bar, or you can use the chat feature. Any question that needs immediate assistance, I will go ahead and answer. Otherwise, all questions relating to the presentation, we'll just hang on and answer those at the end. As a reminder, this webinar is not worth CPE credit today, so thank you for joining. And we're going to go ahead and turn this over to Tanya and get started. So Tanya, if you click on the screen, you should have control.
Awesome. Thank you, Amy. Welcome, everyone. Thank you for joining us today. Obviously, you know, today is our first of our series of 3 roundtables. Like Amy said, my name is Tanya Rule, and I lead the Affordable Care Act services for Eide Bailly. So this is actually my 20th year at Eide Bailly. I've been doing the ACA since it came out in 2010, so I've been studying it for quite a while. With that, I'm going to pass it over to Sean, let him introduce himself, and then we'll get started.
Yeah, hi everybody. My name's Sean Delury. I've been with the firm for about 9 years, and I have 15 years of consulting and accounting experience. I also have been working with the ACA since it was passed in 2010, so I've been involved with it for ever since it started, and it continues as we'll go through today. So that is my intro. Hand it back to Tanya.
Perfect. Thank you. Like I had mentioned, we have 3 roundtable events coming up. So if you haven't signed up for the other 2, go ahead and log on to our website and sign up, please. What we've done is we've asked all of our participants for questions, and we've put those questions in the 3 categories listed here. So if you asked your question and it's not getting answered, we might have felt like it fits more in on the 25th category. Some of our questions, quite a few actually, were similar. So this is the grouping that we came up with. If after the 23rd we have not answered your question, please just email Sean or I. It means maybe we didn't understand what you were asking. Some of the questions were a little vague, so we wrote down what we thought the question meant. So again, if we don't hit on your question, please just give us an email. So with that, the biggest question of the day, right? What has changed? Has COVID changed anything? Well, I'd like to say yes and no. What has changed? Has anything changed? The forms really haven't changed much. The 1095-C, if you've looked at the draft 1095-C form, you will see that has changed quite a bit. You know, we haven't had any changes on that form since it's been out. And now because of the new ICRAs that came into effect in 2020, those are individual coverage health reimbursement arrangements. Because they came out, the form has changed. We'll get into that form. I believe it is on the last session in October. We'll talk about the different coding. But short of that form changing, nothing else has changed. We'll talk about the deadlines in a minute or later on today. Now, has COVID changed anything? Here's what I get from employers all the time. They say, hey, listen, we have furloughed our employees. We've terminated some, we've furloughed half of our staff. So we are now sitting at 45 employees, for example. Does that mean we're not a large employer for 2020? And unfortunately, that's not what it means. So Sean will go into a little bit more detail on how you know if you're an applicable large employer. Remember, those applicable large employers, those are the ones that are subject to the pay or play penalties, meaning if they don't offer affordable and adequate insurance, they could be hit with a penalty on those full-time employees. That large employer status is always based on the prior year hours. So if I'm a large employer in 2020, it means my 2019 employee hours hit the limit, meaning I hit 50, so I'm a large employer for the following year being 2020. So this year, if your average, because maybe your furloughed employees or your terminated employees, they have 0 hours, and when you run through that calculation, on average, you have 49.99 full-time equivalent employees for 2020. That simply means that in 2021, you will not be a large employer. So again, please don't confuse that. There's quite a few penalties that you could be subject to if you're not offering affordable and adequate insurance. Also, if you're not filing the forms, you're going to want to watch for that. I believe we talk a little bit later about those furloughed employees and where that offer needs to be made. So with that, Sean, I'm going to hand it over to you and let you take the next 2 bullets.
Okay, so yeah, Tanya did a good job outlining what's changed with COVID, and she talked a little bit about the ALE status. I'm going to dive into that a little bit more. As the first question alludes to, how do I know if I have a reporting requirement? And that is more often than not determined by, are you an applicable large employer or not? So just to dovetail kind of on what Tanya said, so the 50 is the number still to see if you are an applicable large employer or not. And the 50 is in terms of, do you have 50 or more full-time equivalent employees? We bring this up, this is the 5th year we're going into the 5th year that we've done this, the reporting, but we still get questions from clients, and rightfully so, on are we a large employer or not. So we've talked about it, ever since we started this, but we continue to hit it because based on our client base and the questions we receive from people on the webinar, there's still questions on reporting requirement and ALE. So 50 full-time equivalent employees, and how that works is it looks at both full-time employees and your part-time equivalents. So full-time employees for the ALE calculation is you look at it every month, and you look and see, do you have 120 hours or more in a month? So if you do, then that employee counts as an employee of 1. You count how many you have for each month, and that's your number of full-time employees. So we've had questions about, well, what if they work more than that? They work 40 hours a week. That's 160 hours a month. That's still an employee of 1. So if they work more, they're still 1 full-time employee for the calculation. So if they're under 120, then they're part-time equivalents, and you add up all those hours for every month. We'll start with 1 month and then divide it by 120, and that's your part-time equivalents. You take your full-time and part-time equivalents, add those 2 numbers together, and you get your full-time equivalent employees for the month. You fast forward, do that for every month of the calendar year. You get the total number of full-time employees and equivalents you have. Take that number and divide it by 12. That's your average you had for the year. Take that number, if it, like Tanya said, if it's 49.9, you get to round it down to 49, and you're under the 50. So that in a nutshell is how you figure out if you are an ALE. We have, a calculator to use if you want. We do it for a number of clients. A lot of software providers offer it too. A lot of clients do it on a spreadsheet, and they have us audit or look at it too if they're wondering about that. One thing to keep in mind on the reporting requirement for ALE, in addition to that, is do you have aggregation or control groups? So do you have parent-sub relationships with your ownership? Or do you have brother-sister companies? Because those will need to be aggregated to figure out if you are at that 50 number or not. That's another thing we get questions on from time to time. So that ALE is determined whether you have a C form, and the 1094 and 5C forms is to say what employees were full-time and did you make offers to those employees. And those are used to help the IRS and the exchanges look at if there's any penalty potential for you if you're an ALE. So on the other hand, there's the B forms as well. So that's another reporting requirement. If you're a large employer and you're fully insured, your health insurance carrier will largely do the B forms, as the B forms say who is a form that shows who was enrolled in coverage. If you are an applicable large employer and you are self-insured, you won't do the B forms more likely. You'll do part 3 of the C forms. So that's another thing you could do instead of just the Bs. The other thing to keep in mind, if you're an ALE, if you're not an ALE, then you will have the B forms to do if you're self-insured, and the responsibility is on the organization or employer to do that. So that's another area to keep in mind is if you're not an ALE or an applicable large employer, but you're self-insured, you still have a reporting requirement on the B forms, and that will more likely than not fall on your hands versus a health insurance carrier. So that's at a glance what the reporting requirements are. They continue to be the same as Tanya pointed out, so not a lot of changes there. So are we calculating things correctly? I went over the ALE calculation, so I'm not going to dive into that much further. The employee counts to determine whether an employee should be offered or not is based on what method you use. So are you using the monthly method to calculate whether an employee is full-time, or are you using the look-back measurement period method? As Tanya said, we have 2 other Q&A sessions we're going to go over, and the determination of a full-time employee is going to be covered on the next session. So we'll dive into that more detail because that's a session in and of itself. So that'll largely dictate who you make offers to. Again, affiliated entities are important to look at to see if you're an ALE. It's also important to look at to see if how you're filling out those 1095Cs. If you have affiliated entities, you want to look at the hours that are across all the entities for an employee. So say I am an employee, but say I work for different companies. You would want to aggregate my hours across all those entities to figure out if I'm a full-time employee or not. Also, you're going to want to look at where my hours fell for which company to see which form I get reported on. So we get questions on that around affiliated entities, and that's another area to look into. So it's, in short, it's which entity has the most hours is where that employee should get reported. And we'll cover that in more detail in terms of whether you're doing the monthly method or whether you're doing the look back method. So those were the questions that we got on those 2 areas. They were pretty broad in terms of calculating correctly. Obviously, you want to keep in mind the affordability, which we'll cover, I believe, on the 3rd Q&A. The full-time employee that I talked about again in the 2nd session. I talked about the ALE status. Important to make sure you're at 50, you're under 50, or just to calculate that right, to make sure because you might have a filing requirement or not. And then keep in mind affiliated entities, to make sure that you're looking at what form that employee goes on, and to make sure you're calculating including all of those hours. With that, Tanya, I'll push it back to you to talk about the penalties.
Perfect. Thank you, Sean. And just to piggyback off of what Sean said there, you know, we do have some large employers that do file the B forms for clients that that aren't full-time. So if you are a large employer and you're self-funded, you have the option of putting those individuals that are not full-time for any month of the year on a B form. So we do still have clients that do that, not a lot. They typically like to just put them on the C forms and code them as such. So now let's talk about the 2020 penalties. So we have the 2 penalties, just like we have had over the past years. We have the 4980HA penalty, which you can see there is $25.70 per employee. It exempts the first 30. So real quick, we're going to talk about that calculation, and then we're going to go into the B penalty, and then talk a little bit about the furloughed employees and what that does for them. So remember, just so we have some good background to understand the penalties, let's talk about how the A penalty works. So if we don't offer substantially all of our full-time employees insurance, and we're a large employer, and that substantially all I should say is 95%. If we don't offer substantially all of our full-time employees health insurance, and one of those employees goes to the exchange and qualifies for a premium tax credit, that's going to trigger the 4980HA penalty. And that penalty falls on all of our full-time employees less 30. So we could have 100 employees, or we could have 1 million employees, and we only get 30. If you're part of a controlled group, you have some other members in your group, you're going to have to divide that 30 up. Each of them don't get their own 30. And I should say, if you are one of the unfortunate ones that have received a notice, you will see that the IRS does not divide that 30 number up correctly. So it's supposed to be divided up according to the full-time employees. You're going to want to write back to the IRS and show them that calculation, and then they'll change your penalty. So let's say I have 100 employees and I offer 94 of those full-time employees, I should say 100 full-time employees, and I offer 94 of them health insurance. If one of those other 6 employees goes to the exchange and receives a premium tax credit, I'm going to be hit with a penalty, and that will be 70 employees times the 2570. That will be my penalty. Now that 2570 is an annual penalty, so it actually breaks down per month. So if I did my 1094-C and I said, listen, I didn't hit that 95% test for 3 of the months, I would only be hit with that penalty for 3 months. Now the 4980HB penalty, remember that's our unaffordable or inadequate penalty. So if we offer insurance and one of our employees says thanks but no thanks, it's not affordable, and goes to the exchange and receives a premium tax credit, I'm going to be hit with that 3860 unaffordability penalty or inadequate penalty. That is our 4980HB penalty. That penalty is only hit on the employee that goes to the exchange and receives a premium tax credit. And it's always, the maximum of that penalty will always be the max of the 4980HA penalty. So now let's talk about those furloughed employees. What happens with them? Well, like Sean said, we're going to talk about the measurement periods in our next session. So those furloughed employees really matters if you're using the monthly or the look back. And just real briefly, that monthly measurement period says, all right, if I look at that employee and they're 30 hours a week or 130 hours a month, I classify them as a full-time employee. Again, this is just real brief so we can understand what to do with those furloughed employees. If that's what I'm doing, then those furloughed employees are going to have 0 hours, so I wouldn't need to make them an offer of coverage. However, if I use the look back, so again, let's just say I use a 12-month look back for a calendar plan year. So I use a look back of 2019 to determine who I need to make that offer for in 2020. If I do that and if I furlough a full-time employee, I need to make that offer of coverage during that furlough. They're still employed. I understand they probably don't have any hours. They're probably not using their vacation for their furloughed time. But because you use the look back and because they're deemed full-time in their stability period, you need to make them an offer of coverage, or you may not hit that 95% test. Remember, you always want to hit that 95% test. Otherwise, substantially all of your full-time employees won't have that offer of coverage, and you'll be hit with that 4980HA penalty. Now, I should say most employers are offering COBRA coverage. COBRA coverage is still an offer of coverage. So the next question says, do we still need to report on the number of employees? Good question. If you're full-time and you're a large employer, then those full-time employees, yes, you need to give them a form and you need to report on them. If you're not a large employer, then you wouldn't need to report on any of those employees unless you have a self-funded plan. So how do we know what's compliant and what if we're not in compliance? So if you're a large employer, and I would suggest you keeping that calculation in with your records to be able to show the IRS how you came up with the idea that you're not a large employer. If you had someone review it, keep that reviewed statement from them in the file. If you're a large employer, you do have a filing requirement. Now, if you're not in compliance, my suggestion would be go ahead and get in compliance before you get a notice from the IRS. So the IRS is sending notices. They're called a 5699 letter to employers saying, hey, where are your forms? Are you a large employer? And you'd have to respond back to that. Again, if you're not in compliance, please get your forms filed. If you have 250 or more forms, you're going to have to find a service that will e-file those forms. So I've been round and round with the IRS asking them, can you accept paper filed forms? A lot of software companies don't allow you to electronically file prior year forms. We do have a few software companies that allow that, but you're not going to be able to paper file those forms for a prior year if you have more than 250 forms. The IRS won't move on that. They said they have to be e-filed, which is true. What documentation is required when an offer is declined? So the regs don't require you to get a written statement from the employee when they waive coverage. However, it's highly recommended. When an employee waives coverage, my suggestion would be either get that electronically signed waiver or that paper signed waiver and keep it in their file. I would also suggest keeping their hours in that file so that if the IRS wants to see who was full-time and whether their hours met the full-time requirements, you have that documentation to show them. We'll talk a little bit later about the records and what they should be keeping, what you should be keeping. Because remember, there's no statute of limitations on these forms. So I don't know if everybody saw that, but in February that was announced. It was a chief counsel memorandum that came out that said since the penalties, you can't tell what the actual penalty will be, right? Because we have to wait and see how many individuals went to the exchange to receive a premium tax credit. We really can't assess what that penalty amount would be, so we can't have a statute of limitation on those forms. That means if the IRS wanted to, they could go all the way back and look at your 2015 forms. So please keep all records filed and make sure that they're filed so that the next person that comes into the office, if you should leave, can understand your filing system. We've had that happen over and over again, where it's hard for us to understand what's going on because the person that did the filing and did the record keeping is no longer with the entity. So with that, Sean, I'll let you talk for a minute on the Supreme Court case coming up.
Okay, yeah, I'm sure some people are watching this, and we just do because it could obviously change the ACA quite a bit. So what is the status of the Supreme Court case? As you maybe remember, there was 2 cases so far the Supreme Court heard on the ACA, and the opinion or the vote was in the affirmative to uphold the ACA in both of those cases. One was 5-4, that was the larger one on is the tax a tax, and then there was a piece about Medicaid where the Supreme Court said you can't coerce the states to take Medicaid expansion. So we have an option now on Medicaid expansion. The other one was a 6-3 decision on whether state-based exchanges were allowed to receive and have subsidies because the rules said it was for federal exchanges, and the Supreme Court voted 6-3 against that, saying no, state-based exchanges can have subsidies in their exchanges just as federal ones can. So the one that's up right now is Texas was originally Texas versus United States, and it was about the individual the mandate penalty again. But this case, Congress said they pushed the penalty to 0, and Texas was making the case that the individual mandate was then no longer constitutional because it was set at 0, and they wanted to get it removed. And a judge approved that in Texas, and then the State Court of Appeals voted 2-3 in favor of that, saying, yeah, the tax should be unconstitutional. It's set at 0. One of the other judge said, no, it's just set at 0. It doesn't mean it's unconstitutional. There was another question within there saying, does this make the ACA entirely unconstitutional because of the severability clause within it, saying if we get rid of the individual mandate, does that get rid of everything else with the ACA? Does the whole thing kind of unravel? And what the Court of Appeal, 3-judge Court of Appeal said was the analysis was, what they basically said was incomplete. So they sent it back to Texas to continue with their look on that issue. At the time that was made, the House of Representatives, the United States House of Representatives, and coalition of Democrat-governed governor states pushed for the United States Supreme Court to hear that case on an expedited basis. I think it was in the spring. The ACA or the Supreme Court ruled back saying, no, we're not going to hear it on an expedited basis. And then shortly after, they said, we're going to hear the case in October of 2020, and then they'll issue a ruling on it in the spring or summer. So We won't hear, they're going to hear it in October. We're not going to hear what their opinion is on it until after the election, looks like in the spring and summer. And the issues at stake there is the individual mandate unconstitutional because the penalty is set at 0? And then if so, does the entire ACA become unconstitutional because of the severability clause in that? So we'll see what happens with that. I don't try to read tea leaves too closely, but a lot of people are suggesting that it's going to probably stay because they don't see the argument to be very, I guess, strong on the side to strike it. But people have been wrong on that too. So we'll see what happens, and we won't know until the spring or summer. So that's a bit on the Supreme Court. That's the only case I think that's on the docket for the ACA this year, and that's the only thing that's come up to rise to their level of attention. So on the reporting, how do I report is the next question. How do I report accurately? Well, obviously attending these webinars helps understand the rules and regulations. The biggest piece on accuracy, I think, is we've been doing this, is on full-time status, who's a full-time employee and who's not. As Tanya articulated earlier, that gets to be in terms of the 95% rule, which could lead to an A penalty if we're under 95%. So knowing who's full-time under the appropriate method is very important. We'll get into that more detail on the next session on the monthly method versus the look back method, the two approaches. And then on the forms, having the right coding is obviously important. We'll get into what situation gets the right codes in the third part of our series. And then, like I said earlier about ALE status, that's important. So knowing whether you're an ALE or not, that's knowing if you have a C requirement or not. Affordability becomes an accuracy question. Do we use the right method? Are we calculating it right? And do we offer affordable coverage or not? Can we put the affordability safe harbor on the codes or not? Remember, there's 3 methods, which we will go over: the federal poverty method, the W-2 method, and then the rate of pay method. And then dovetailing on affordability, there's this question of family and employees. I think we got a number of questions from employers wondering if what's the requirement on affordability? Well, affordability, if you're trying to get the safe harbor, it needs to be affordable for the employee. It doesn't yet have to be affordable for the family. All that the IRS asks to not have a penalty is that you offer health insurance to the family, or i.e. dependents and spouses. So it doesn't need to be affordable, it just needs to be offered. One thing to keep an eye out though is that moving forward, the Democrats are talking about extending affordability to the family. So, if they get into power in the election and they can push it through, they may push through the requirement to have affordability for families. So not yet, but could be in the future. Individuals working in multiple entities, yeah, that's a very important piece of it. So if you have multiple locations or multiple entities related to the control group or aggregation, you want to keep that in mind too. So with that, I'll pass it back to Tanya to talk about the requirements.
Perfect. Thank you, Sean. So like Sean said, yes, the IRS wants you to offer that to they'd love for you to offer the family coverage, but remember, you're only required to have it affordable to the employee and to make that offer actually to the dependents. So that gets into the filing requirements. Will they change? They're not going to change for this year. They still want you to just make that offer to employee and the dependents. Spouse isn't mandated yet. We don't anticipate the filing requirements will change. So right now, we're still waiting for the forms to come out. I'm sure most of you have seen the draft 1095B form and the draft 1095C forms. The filing deadlines have not been extended yet. So that means they'd have to go to employees by January 31st. And then if you're going to mail them in, mail them by February 28th. And e-file is March 31st. Now, a couple of those deadlines are on the weekend, so you would have until the following Monday. If you're mailing them to the IRS, I would suggest that you get some sort of return receipt. We have had the IRS come down on clients saying, hey, we don't think this was mailed in time. So then the client had to dig up some proof to show that it actually was mailed on time. So you're going to want to do that. as far as this, there are some states with some filing requirements. California, for example, they have a filing requirement. So you're going to want to watch out. So if the IRS were to extend that deadline, like they have in the past, let's say they extend the deadline from January 31st to February 28th, and if you have an employee that has taken your coverage and you have a self-funded plan and that employee is a California resident, you're going to want to make sure that the California has extended their deadline to meet the IRS's deadline as well. Otherwise, that form to the employee will be late. So right now, kind of a heads up of the states that you're going to want to watch out for is for 2020, you're going to want to watch for Rhode Island, Vermont, DC, Massachusetts, New Jersey, and California. So I suspect that if something were to happen with the ACA, we're going to have more states come to the table. More states have been talking about maybe coming to the table with an individual mandate, so watch that. Like I said, those are states that I just mentioned are on the hook for, you're on the hook for 2020, so watch if you have an employee in those states. As far as the good faith effort reporting, we could talk about that for quite a while. That has not been extended. I kind of have a feeling the IRS isn't going to extend it this year. You know, they kind of got their hands slapped with that report that came out in June 10th, actually, from the Treasury Inspector General for the Tax Administration had actually released a report and said that they felt the IRS should be coming down harder on these ACA penalties. What they found was that employers were letting employers make the same mistake a couple years in a row, and they felt that even with a reasonable if you make a reasonable effort, that should have been a potential penalty situation. So I've read different articles saying, hey, when the IRS starts looking at their 2018 forms, will they come down harder on those, or will they abide by that you made a reasonable effort on those forms? That's yet to be determined. I think the IRS is probably going to let you get off the hook for another couple of years on those penalties, meaning for 2018 and 2019. I don't know that they're going to give us that good faith effort reporting for 2020 because of that report that was issued on June 10th. So watch for that. We typically don't know that until the end of November, and that's when they release a notice saying if we have an extension of those deadlines. So it is 11:31. I'm going to talk really, really quick on the record keeping. We already talked about the record keeping and how there's no statute of limitations. So again, keep those records. I would also suggest don't just depend on the payroll software to keep those 1095-C forms. We've seen it before where those payroll entities will update their software and then it changes all your prior year forms. So go ahead and get those printed to a PDF and save them out on your computer so that you have a copy of what was actually filed with the IRS. So with that, Amy, I don't see any questions in the chat box, but I don't know if I'm looking at that correct.
I don't see anything either.
Okay, so if you have questions, again, that aren't answered after our October session, go ahead and email us. If you haven't signed up, please sign up for those last sessions. Thank you, everyone, for joining us. Please stay safe and take care. Amy, I'll throw it back to you.
Awesome. Well, thank you guys so much for attending, and thank you to our presenters, and we will chat with you guys next time. Have a good day, everyone.